Hello friends, I am Pankaj Daga, your knowledge buddy, welcomes you all to new edition of this week. We are in December 2018 and soon most of us will start our endeavor to make tax planning more prudent. Our today's topic for discussion is the same, that is tax planning for year 2018-19, also known as assessment year 2019 and 20. I'm sure most of us would have already chalked the plan for this, but here we have made an attempt to discuss few lesser known facts about tax laws and how can you get benefited out of it. This series will carry two videos whereby part 1 will be more from current tax slabs and how to compute tax liabilities. However, part 2 would be more from effective tax planning and detailed analysis of sections from Income Tax Act. So friends, let's begin our today's journey with essentials of tax planning. Tax planning is simple four-step journey which will enable you to assess your current situation and plan more prudently. It begins with step 1 of assessing one's financial situation. Here, one is expected to analyze short term, middle term, and long term goals and take a stock of available resources. Once you are done with the step 1, then you are expected to understand changes in tax laws and its impact on your planning. Here, experts' advice will always be beneficial. If you understood changes and impact of recent tax laws, then you should plan your investments whereby you can make stable portfolio which can fetch you high and sustainable return over long term. While doing all above steps, one should not get diverted his attention from deadlines as penalties of not adhering timelines is humongous. We all know paying tax is a moral responsibility and we all should perform it. However, doing it smartly in order to make optimal utilization of your hard earned money is self responsibility. We at L&D Show will help you to do so. Tax burden can be reduced in two ways, either by making tax deductible expenses or availing few allowances or exemptions. Before jumping onto more technical aspect of this topic, let's first understand tax slabs of financial year 2018 and 19. To begin, we will analyze tax slabs for an individual aged below 60 years. Majority of taxpayers form a part of this group. As one can see, till income of 2.5 lakhs, there is no tax. Post that, tax will be levied at the rate of 5% for income from 2.5 lakhs to 5 lakhs. From 5 lakhs and above till 10 lakhs, income will be taxed at 20%, and anything above 10 lakhs will attract tax at the rate of 30%. In Union Budget, there were few changes made with respect to cess and standard deductions. Cess was renamed as a Health and Education cess and got revised upwards to 4% from earlier levels of 3%. Standard deduction of 40,000 was introduced for all categories. However, surcharge at a rate of 10% for income above 50 lakhs but lesser than 1 crore and surcharge at the rate of 15% for same above 1 crore kept unchanged. Let's understand how to compute tax liabilities with few examples. Meet Mr. Fresh who recently completed his studies and started working. His current income is 3.5 lakh per annum and he has no investments made till now. Since his income is equal to or lesser than 3.5 lakh, we first have to focus on new addition of a rebate under section 87A. This section provides rebate of 2500 or actual tax whichever is lower to individual earning lesser than 3.5 lakhs per annum. Thus, Mr. Fresh's tax liability would be 5000 rupees on incremental income over and above 2.5 lakh, that is 5% on 1 lakh. From this, we have to deduct rebate of 2500, resulting in final total tax liability equal to 2500. Moving ahead, now let's meet Mrs. Experienced, who is successful manager and carry a decade-long work experience. She earns 15 lakhs per annum and perform investment judiciously in life and health insurance, PPF, FDs, etc. Mrs. Experienced would claim maximum limits under Section 80C and 80D, which are 1.5 lakhs and 25,000 respectively. She may also claim deductions of INR 10,000 towards interest earned on saving bank account balances under Section 80 TTA, along with standard deduction of 40,000. This will make her adjusted gross total income or net taxable income to rupees 12,75,000, on which 12,500 will be taxed for income from 2.5 lakhs to 5 lakh. INR 1 lakh will be charged as a tax as a result of 20% on a 5 lakhs, and 30% will be charged on a income above 10 lakh, that is 82,500 on incremental income of 2,75,000. We will also look at example of Mr. Top Gun, who is at a pinnacle of his career and earns 2 crore rupees per annum. All computation will remain same till we reach total tax levels as per tax grid. Only we need to compute surcharge at the rate of 15% on entire tax amount, since his income is more than 1 crore to reach final tax liability. I hope these examples will give you some insights on how to compute tax liabilities. As we have understood with examples how to compute tax liabilities, now we will look at tax slabs for senior citizen, that is individual aged between 60 years to 80 years. They will enjoy discount of additional 50,000 on first slabs, keeping rest of the slabs same. That is, till 3 lakh rupees of income, one need not to pay any tax. For super senior citizen who are aged above 80 years, there is no tax till income of 5 lakh rupees. Post that, it will be taxed at 20% for income between 5 lakhs to 10 lakhs and 30% for income above 10 lakhs. Rest of the conditions on cess, standard deductions and surcharges remain same for senior and super senior citizen. We had already touched upon standard deductions and increase in cess. Let us now introduce few additional changes made in tax laws for financial year 2018 and 19. To begin with, Section 80 TTB, which newly got introduced for senior citizen, under which one can claim deductions up to 50,000 towards interest received on saving bank balances. Even health insurance premium payment for senior citizen will attract enhanced deduction of 50,000 compared to earlier 25,000. All these clauses are discussed in part 2 of video in detail. Widely debated and discussed long-term capital gain tax on equity and equity-oriented products got introduced, whereby 10% LTCG will be charged on capital gains above 1 lakh. This clause is grandfathered later for all equity and related products bought after 1st Feb 2018. Also, 10% of dividend distribution tax on equity mutual fund got reintroduced. Now, even infrastructure bonds do not attract any tax benefits, and there is no differential treatment for men and women in tax laws of financial year 2018-19. Let's now look at all options available under widely known Section 80C, which provides maximum deduction of 1.5 lakh rupees per annum. For better understanding, we categorized investment options under three heads. First, investment products like PPF, Provident Fund, Sukanya Samriddhi Account, National Savings Schemes, or tax benefit FDs for more than 5 years. Second, as other effective options which includes premium of life insurance, pension plan, new pension scheme which attract enhanced deduction limit, ELSS, etc. Lastly, few expenditures like principal repayment on home loan, tuition fees or stamp duty and registration charges. Combinedly, all put together provides tax deduction of 1.5 lakh. This can be smartly enhanced. Let's see how. We have decoded some of the key details which will help you either to take full benefit or enhance your benefits efficiently. While claiming for overall deductions of INR 1.5 lakh under Section 80C, one tend to forget benefit provided towards payment of tuition fees of two kids. The only condition is that such fees should have been paid for full time education including nursery. One also need to note only tuition fees are allowed to claim for deductions and not donations or any kind of a late fees or expenses towards transportation and mess. We would like to bring you to your notice that there is a provision to enhance deduction limit by another 50,000 by investing in new pension scheme. This benefit can be claimed under section 80 CCD 1B as additional exemption over and above the original exemption of 1.5 lakh rupees under section 80C. Isn't it amazing? So friends, we have this much only in part 1 of tax planning series for you. So stay tuned for more to explore hidden pearls to save. We thank you for watching this video. Don't forget to subscribe to our channel and also hit like and bell button to receive our next update. See you soon. Till then, have a great time.